Good morning and welcome back to the latest edition of InvestTalk Market Analysis for the week ending November 10th, 2023. And today I'm going to title the video, High U.S. Debt is a Problem. How will a debt downgrade impact markets? And that's really the news of this week, because it was a very light economic calendar. It's pretty much nothing of interest, so I'm not really going to go over that. But after the bell on Friday, you had Moody's issue a negative warning or negative downgrade watch for U.S. credit. And this is the big story here. I talked about this on the webinar on Wednesday. This is the backdrop that kind of colors everything going forward because of how important the U.S. economy is to the global economy, how important the treasury market is to the global financial system and the banking system, and how things trend on that front. It will certainly be impactful. Now it's going to ebb and flow. Nothing moves in a straight line, but you clearly are seeing treasury markets become dysfunctional over the past year, and we're going to talk about why that is. Now, before I move on, I'm InvestTalk host Justin Klein. I appreciate you all tuning to this channel and liking and subscribing to our podcast, InvestTalk. Now, this is big news because Moody's is the last of the three major rating agencies to downgrade the U.S. Debt. Now, actually, they haven't downgraded it. Okay, Fitch did it earlier this year. S&P did it some years back. But basically, this is going from stable to negative credit watch on large deficits and decline in debt affordability. So what's interesting is that they're leaning more with the debt affordability part, which I've always thought was the bigger issue than the government shutdown, right? It's a lot of political grandstanding, and eventually they come to a deal. And both sides spend more. Okay. Now, they did say that continued political polarization in Congress raised the risk of lawmakers not being able to reach consensus on a fiscal plan to slow the decline in debt affordability. So that's what they're focusing on. So while the S&P still has them at AA+, Fitch has it at AA+ as well. Moody's is still at AAA, but likely to downgrade probably soon. Now, they also state that the sharp rise in treasury yields has increased pre-existing pressure on U.S. debt affordability. So that's what we talk about. Rising rates, how much can they really raise beyond here? They're already having problems. You see it with the quarterly refunding announcement during last week's Fed announcement, and that was all about, what bonds are they going to issue going forward? Longer dated, kind of shorter dated, and they actually focus on the shorter dated. Why? Because they saw the pressure that rising supply put on the treasury market with rising rates, and that obviously kind of feeds on itself with the mounting debt pile that continues to go higher, which I'm going to talk about here in a minute. I'll show you some charts. Now, obviously, there's infighting within House Republicans on a potential government shutdown that could happen. I think it's next Friday when that expires. But once again, this is bipartisan. You can have your politics, but it's pretty clear that either under Republicans or Democrats, the debt pile goes up basically since 2000, right? So here is 2000, late 90s, excuse me. You had actually debt to GDP declining. I've said the boom in you have the boom in technology that created a lot of efficiencies within the economy. Productivity of workers increased, and that was great for the economy and our budget. And we entered the 2000s with a budget surplus, and you saw that debt to GDP decline really until basically until 9/11. And then we started the wars in Iraq, and you saw that continue to climb throughout the Bush era. And then obviously at the end of the Bush era, you had the boom, you had the financial crisis and the bailouts right in 2008, and Obama took office right in 2009. It continued to increase because you were in a deep recession. A lot of the fiscal stabilizers, unemployment, et cetera, they passed a fiscal package about 800 billion, which at the time sounded like a lot, but compared to what we spent in the COVID era, it pales in comparison, right? But really, throughout the Obama's second administration, second term, debt to GDP was pretty much flat, right? Uh, right around the 100 mark, and then you had Trump come into office, and then they had the tax cuts, and that started to rise. Let me see. Let's go here. Let's zoom in. There we go. This is a little bit better, right? So Trump came in 2018, 17. The tax cuts. The economy grew, but it didn't do anything to our debt, right? Dramatically, one way or the other. It did increase up until kind of early 2020. You saw that the economy was weakening going into COVID, and then you just had the explosion in debt, right? Now it's come back a little bit, but we're still at very high levels. And what you can see here is this a fiscal year-end interest expense ratio, and that is approaching $1 trillion. And I don't think that's going anywhere. Right. But it also means how much can the Fed really raise rates? So they're kind of through a rock and a hard place. I think they are jawboning that they're going to potentially raise rates again. Powell came out this week and talked about that. But it's pretty clear with our fiscal situation, you're just pouring gasoline on the fire. And I don't see them raising much more or any more. Now, in December, the odds now are 91%. Of a pause. Now that's down from 95% 1 week ago. And a rate increase going from 4.8 to 9.1. So obviously it was a hawkish week overall. And you saw that in the dollar, which I'll show you in a minute. January, you're at 77% of a pause, down from 91% of a pause. So clearly that was a catalyst for the dollar to go higher on the week. I'll show you that here. And it was, right? The Fed meeting brought weakness, and you had pretty much strength throughout this week. And the jobs data, last week, brought weakness to the dollar. But you had a little bounce back. But you can see here, is this now in a downtrend? Potentially, right? This is more of a 50-day moving average for the first time in this entire move, and you're consolidating kind of near it. So I think this is threatening to break it. You're not seeing a MACD turn back up. It's still remaining fairly in a downtrend. So I think the dollar will likely peak out, or has likely peaked out. But we'll see. If the dollar has peaked out, that's going to be good for asset prices. This week, you had pullback for most of the week, a good day on Friday. Obviously, small caps were the weakest. You could see some further weakness through year end due to tax loss selling, kind of like last year where tech was very weak into year end. I could see you seeing strength in the large caps and weakness in the small caps into year end. But overall, equities are likely to, I think, head higher. Okay. You had that follow through week. You had the reversal week on, you had the reversal week last week. I've got a weekly chart on the S&P, and then you have the follow through. Okay, get rid of this. Now that we found that support, actually, let me show you that. I talked a couple weeks ago about how this is major support. We got that reversal on that 382 retrace, and now we're making a higher high, right? And that is constructive. That's positive for risk assets, as well as the fact that the debt markets are hanging in there. Here's the credit spreads that reversed last week and basically consolidated in a bullish manner. So that is all telling me that you are likely to get a risk on environment into year end. Doesn't have to be a strong risk on environment, but a risk on environment nonetheless. Interesting here was commodities. Commodities did kind of roll over pretty hard. Gold pulled back pretty significantly, although that is in an uptrend. It was really about the oil. Oil pulled back. Now that is once again into support, just like gold is. And there was this is a tire reversal from the Hamas attacks and the increase in tensions in the Middle East. And I think there was a lot of positioning for unwind, and that's what you've seen recently. There were some product builds, the reports, basically inventory starting to get less tight, and so that brought the oil prices down, but into support. And I think this could potentially be a buying opportunity if you look at the XLE that also is entering this area where it broke out from in the month of July, right? We had this kind of consolidation area, trading range, and then we broke out, and that typically is a good support level. So we'll see what that looks like going into. Let me run this fib real quick. Yeah, we're into that 618. That's what it looked like to me. 618. This is good support for the energy stocks. All right. What else do I want to get to? The MOVE index. We know we talked about the treasury market. We'll see what kind of dysfunction we get next week, potentially, due to this downgrade. But you can already see, here's the GLD. I'll go to the short-term chart. After hours gold up. Let's look at SPY. That was down on the debt downgrade. You can see that kind of after hours. What did the treasury market do? IEF, yeah, so this is down, right? So this is the 10-year treasury bond. So rates are likely to head higher on this downgrade after on Monday. So, while we got a pullback in rates, you're still in an uptrend until, I'm kind of watching these levels here. So go here. So this is the reversal. I think it was that last Friday? No, it was on the Fed meeting. Right. So that was that reversal bar. We'll see if we can get above that. If we get above that, then you're seeing, you're going to take another leg higher. But if we break this week's low, then that could mean this is more in a downtrend. So I'll be watching to see which way the rates break, one way or the other. All right. What do I want to get to? Let's go growth to value. So let's just SPYG to the SPYV. So growth definitely had a good week after a pullback last week. So could you be getting head and shoulders in this? I think that's something I'll be watching for as well, to see if you get a lower high or a higher low going into next week. So obviously growth had a much better week this week. Let's see what else. Let's look at the silver to gold ratio. Talked about gold pulling back. This one needs to get traction. I need to see silver really break out here. This is not looking as constructive as I'd want it to be. So we'll see what that looks like going into next week. But gold in general is at some support. This breakout area, right? You have this breakout pullback. And obviously next week should be higher, at least on Monday, on this debt downgrade news. Let's look at the banking industry. This is starting to look constructive here, right? This reversal pullback, this is a reversal candle on Friday. And this is kind of telling me that maybe rates will pull back, that if you get some strength if you're getting some strength in the rate sensitive parts of the market, you see that with the utility space as well, getting same kind of action, that reversal pullback here, and that could potentially be signaling a pullback in rates, and then those duration trades will certainly take off. Let's look at the XLRE. There we go. So this is the real estate space, kind of same thing, right? You're getting that up move, consolidation, and we'll see what that looks like going into next week. So overall, I think you're in a kind of consolidation period. Market's trying to figure out how it wants to rotate. Are we rotating back into growth, or is duration trade now the right trade? Because rates are pulling back, maybe because of a softer economy. I believe we have some inflation data next week for the month of October. That will certainly be impactful. And then you start getting the holiday season. The week after next is Thanksgiving week, shortened trading week. And usually when you get there, you start to enter a light float week, meaning a light volume light volume float in the equity markets into year end. Those last 5-6 weeks of the year are typically characterized by that, especially when you have an up year, which we have had, not a great up year, but certainly an up year in general. So very interesting market, interesting news on Friday. And we'll see what signals the market gives us next week, because right now I would say it's modestly bullish with potential for, I think, a pullback into next week into the holiday season, and then from there probably some float into year end. All right, thank you all for tuning in. I appreciate you all for liking and subscribing, and a reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a great weekend.